Hey everyone, it's Andy here, and I'm really excited today to be telling you the story of a longtime reader of mine. I'm going to keep him anonymous and call him Mark for now. But he and I were discussing how he just became a millionaire, and I mean a liquid net worth millionaire, which means that he's passed $1 million in his investment account. And I just wanted to share with you his story with his permission of how he got here. He's 40 years old, two kids, lives in the Northeast. So it's really interesting his story of how he recently passed his $1 million mark and how he's been tracking it. And I just want to share some of his story here, not as a way to brag or to say he passed it, but just to give you an idea that it's really possible. And this is a person with a regular corporate job. He does, both him and his wife work. He has two kids. Obviously lives in a nicer area, but didn't start with a lot. But essentially, what he's done is he's been able to invest smartly over the last several years. This is not a get rich quick scheme. It's just regular investing and just to show you how he's investing now and into the future. So for those that are on this journey, and I know many people are investing, very prudently. It's been a really good year in the markets for a lot of people. You can definitely get, to the $1 million mark, and it's really exciting. Like when he was approaching this mark and we were having discussions, it was just that um, how he got there and was tracking. And it's really nice to see the account tick over to seven figures from six figures. And what he did to get there. So with that, let me just show you his portfolio right now, and here it is. You can see it here. It's across a few accounts, but it does include retirement and traditional investment accounts. So it's not just all from his post-retirement accounts, but what it is generally about 60/40 between retirement IRA kind of accounts and 401ks and a normal account, right? So what you can see here is he just passed the mark by $10. So he's got the seven figures, and technically, if you include the cents, it's nine figures. But let's say it's seven figures, $1 million and 11. So it's really nice to see this sort of milestone for a lot of people. I know $1 million is not maybe what it used to be a few years ago, but it's pretty cool to get to this number. You can see here that $1 million is made up of individual accounts, which is basically after tax trading accounts. He's got about $450,000 in there, and then retirement accounts, which is rollover IRA accounts, which is about $543,000. So altogether, he's also got a bit of a Roth IRA, and I'll tell you a little bit of a story about those four different accounts. So his individual account is essentially where he does his stock trading and investing. He's pretty passive. He has a few stocks, but mainly it's ETFs and funds. But that's something I think I would call it the active investing. There's not the tax benefit, so that's something he's putting in every month. $2,000 to $3,000 from his paycheck. So it just keeps sort of dollar cost averaging in, but it sort of grows over time. The one thing with that is because it's not tax advantage, that there is obviously capital gains and dividends. But the good thing is he's been probably had this account for I think 15 years, and he's reinvesting dividends. So it's not really taking any money out, but he's growing this actively, and it's almost like forced saving. So before he gets his paycheck, this money goes straight to his Fidelity account, and then it's put into that and grows. His IRA account, on the other hand, is actually pretty interesting. So that's, Mark's had a few jobs over the last 15 to 20 years of his corporate career. And so what he's done really diligently is that he kept on moving it whenever he moves clients, or he had a couple of acquisitions of his company so that, they cashed out the existing account. He created the IRA account. And the IRA account is just basically a culmination. So rather than having, a lot of people have multiple IRA accounts, because you may not realize when you leave your employer, you can transfer your 401k to an IRA. So he's done that, and also he's contributed extra every year, 6,000 to the IRA, which you can do on top of your normal 401k contributions. And I have a whole article on that, which I'll link to below. But through that, he's built up his IRA accounts. And I think what he's done that really shows why his IRA is more than that is early in his career, he was saving a lot more to the IRA. He had less money to invest because he was buying a house, starting a family. So he had less disposable income to add to his individual investment account, which is after tax. So he focused on obviously maximizing his 401k and IRA accounts at that point. So that's why that's larger. It's a little bit more conservative. So I think you'll see that there, and you may not see this in these figures, but his individual accounts have grown a lot faster because he has taken some, speculative investments in big tech companies, which have done very well in 2020. So that account has actually grown probably 20% versus the IRA account. But the IRA is sort of that mutual fund, steady, slow growth, including, I think he has said he bought a couple of Google and Apple stocks, which have done well for him. So with that, he's sort of got a good balance between IRA and his post-tax individual investment account. The good thing is individual investment accounts can be cashed out pretty quickly, and so he almost that has it a big safety fund. Obviously, the IRAs you don't want to touch due to the penalties until you're past the retirement age. Roth IRA is a small account of his, and Mark was telling me this was just he had a year where his income was below the limit, so he just threw a bit in there. Of course, I think one of his regrets was he should have done more then, but he put a bit in there, and this is almost in a sort of it's his play account because the good thing is he can be pretty aggressive in this. Go for some high growth stocks because it's tax free. Whatever happens in that account. On the downside, it's not overall from his portfolio. $7,000 is not really going to have a huge impact if that goes up or down. So it's almost like gives him a chance to play with it. So if he has upside, that doesn't get taxed. If he loses a bit, he can write out lump. So overall, those are the three ways his accounts are broken up, and so you can see that that's how his accounts are broken up. So I mean, obviously, like I said before, he's pretty good with a mix of stocks and funds. I think definitely in the IRA there's more funds because you can dollar cost average, but in the individual and the Roth IRA, he's definitely been putting in a lot more stocks. My advice to him is to sort of keep the stocks to maybe 5 or 10 because otherwise it gets too hard to manage what's happening with those. But it's been a nice consistent mix of investments there. Um, as I said before, his Roth IRA is a speculative account. Not doing as great this year because I think he took a couple of flyers, but I think it's a place where you can sort of learn to invest. I wouldn't recommend this to everyone, but given that he's got a good amount in his rollover IRA, I think the Roth IRA he can be very aggressive in that. I would say it's still real money. You shouldn't mess around with it, but it's good to have there in case things are going well. It's not doing as great this year, he said to me, because he took a couple of highly speculative companies, which are not thing, but he has, a long-term horizon for this, probably another 15 years. So those should be all right. And this could be a big account for him. Unfortunately, because of his income, he can't contribute anymore to the Roth IRAs, but it's good to have there in the background. And I would definitely recommend people use Roth IRAs if they can, because that is probably the most tax effective way of investing because you don't pay taxes when you withdraw funds, after you reach retirement age. And finally, all this has worked because of dollar cost averaging. I mean, this is not a miracle overnight get rich quick scheme. It's truly been, 15 to 20 years of solid regular investing, maxing out your 401ks, maxing out your IRAs, adjusting your allocations as markets change. So he's built up to the $1 million mark through that. It's there's definitely been some lessons learned from Mark's perspective. I think he's made some mistakes he wish he hadn't. For example, selling Apple or not many years ago when he should have just held on because it's done really well. But also, I think he's become smarter as you get older about picking a good diverse set of funds, low cost, low expense funds. This is with Fidelity, so he mainly uses their funds, but I think there's a lot of good choices now where your expense ratio is very low. So, letting dollar cost averaging and compounding work for you is really what got him to the $1 million net worth mark. And this, is ultimately the real secret sauce for any financial people is this whole aspect of investing in dollar cost averaging and compounding. And then just a quick thing here to show you how his current investment looks like. And I didn't obviously want to give specific stocks. I think that's just to keep the confidentiality. But it's really I think this is a good asset allocation to be honest with you. Anyone who's between 30 and 50 with several years left to work. I think right now with interest rates so low, and there's probably still going to be a lot of growth given the amount of stimulus and government support. Keep it heavily invested in stocks. I think domestic stocks is the place to be for at least the next couple of years. The U.S. should boom. I do think foreign stocks are going to probably outperform over the next 5 years. So I would recommend to Mark to move more funds into foreign stocks. Bonds is 0%. For his age, that's not great, but he feels that bonds are not a great investment anymore. I would still say you should have 5 to 10% in bonds, but he feels that he'd rather have it in Bitcoin than bonds. I don't agree with him there, but that's so he's also decided to keep 16% in cash, which, in this market is not actually a bad idea given the volatility I expect to happen as, stock markets adjust, especially around the new year or the significant political events taking place. I think this will give him some firepower to sort of move into some investments should they drop. And I always recommend keeping a list of, investments you would do if the market drops, especially we've seen that over the last year or two play out where there's always a dip and you can buy and those stocks seem to even do better after the dip. So this is not a bad strategy. And, I definitely support keeping a short amount of reserves because even if it's not for buying stuff, it's good to have as an emergency fund if something changes in your life. So overall, I hope this gives you an idea if what Mark's portfolio looks like, how he's got to the $1 million mark, and that he can do it. Again, it's a journey. It's a marathon, not a sprint. And hopefully, this gives you some insight on how you get it. If you have any questions, any thoughts, any comments, please leave it below. And as always, if you can like and subscribe, I'll be appreciative of that. Thanks. Bye.